Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne Man with David Ingles.
Good Friday morning. Our top stories today: stocks and bonds in Asia catching a tailwind from a cross-asset rally on Wall Street, fueled by the Fed's quarter-point rate cuts. Chair Jay Powell declining to say whether there'll be another cut, though, next month. Now, Chinese assets also in focus this hour as a top legislative meeting concludes today with Donald Trump's potential tariffs increasing the urgency for a large fiscal package. And shares of Nissan in Tokyo slumping substantially, as you can see on your screens, after the company slashed its outlook, announcing a broad revamp, including 9,000 job cuts.
Happy Friday. All it took was another 25 basis point cut from the Fed to ignite this rally and continue it for another day. So this everything rally that you see when it comes to stocks and bonds, that certainly was what happened there. Although, let's face it, though, what we saw from the Fed was pretty much as expected. No surprises there. So the market didn't react too much. But yes, there's still a lot to talk about when it comes to what this means for the direction of policy in December. As Dave mentioned, Jay Powell didn't really quite go there, saying basically we're in a world where we can go either way. We can't afford to rule things out right now. But that still was enough to keep the Bloomberg Dollar Index suffering the worst day since August. We're seeing it pretty much flat here right now. But Treasury yields as well did decline just slightly, just reversing a little bit of the sell-off that we saw post-election. So we're still talking about U.S. 10-year yields at 4.34% here. And we are seeing yields ticking lower across the board in Asia and Australia and Japan in particular here today. Not a whole lot of movement in markets, but really what we're seeing in China has been interesting, right? This breakout that we've seen in the last maybe 24, 48 hours or so. You saw that the Nasdaq Golden Dragon overnight, and it seems like Chinese traders have really just moved on from the election, from the Fed, and now really focus on MPC and what the hopes of more stimulus is going to bring to this equity market. You take a look at how futures are set up here this morning. In terms of where the CSI 300 goes, we basically ended the day yesterday at the highest in the month. Hong Kong stocks are also set to snap out of a 4-week skid. So it's really all eyes on MPC in the next few hours or so, Dave. Oh, yeah, by the way, HKMA followed the Fed with a cut this morning.
Yeah, the peg necessitates that consequential move really coming through out of the HKMA. And certainly things like HIBOR, for example, which has picked up of late, will be consequential too for home buyers, for example. Now, as far as the Fed goes, and certainly when you look at the conversation around China, for example, right, to what extent can Chinese policymakers now extend, this guidance for lower rates and more fiscal policy on the back of a Fed, which seems to be at this point in time, seems to be sticking to the script, although I think the phrasing that Jay Powell had to say about December was he was either out, he's not ruling out or in. But pricing suggests that they're going to do it, they're going to cut again, and you look at the pricing all the way through the end of next year, there's been a minimal change in expectations on rate cuts.
I think it's like roughly 70% chance they'll cut in December. Yeah. But you're hearing more calls from economists out there that maybe 2025 we have to start reducing those rate cut expectations a little bit.
Yeah, particularly when we start to feel maybe some of the effects from, any potential Trump policies. Of course, it might be too early to talk about that, at least mid 2025. In any case, of course, the Jay Powell had a lot to say overnight in the press briefing. Let's have a look.
Recent indicators suggest that economic activity has continued to expand at a solid pace. We got one inflation report, which it wasn't terrible, but it was a little higher than expected. We're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points, and we're asking ourselves, is that where we need to be? We're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves.
Fed Chair there, Jay Powell. Let's bring in Bill Lee, Chief Economist and Executive Director at the Milken Institute, joining us now to help us unpack some of the reading between the lines that we may have to do here, Bill. Bill, let's start very simple. Do you think the Fed will cut in December?
the one thing that Chair Powell wanted to do was create optionality, and he did it by saying everything's still on the table. If the data come in hot, as it has been, and inflation over the next two reports that between now and the next meeting come in even hotter, and it shows that the core rate not only is at 2 3/4, but maybe be going up a little bit, we're not going to see a rate cut, because they certainly are very patient about getting the right amount of restraint in place so that inflation really does come back down to 2%.
What did you make of his how he fielded these questions about what a Trump win could mean for Fed policy? He basically said, we don't guess, we don't speculate, we don't assume. Should we assume that they're already thinking about this? At least, you know, when December comes, should I expect those dots to change dramatically?
You will expect the dots to change for sure, because the economy itself has actually come in hotter than people thought. So the forecast by itself will change. But as I hate to say that, as a staffer who was back at the Fed during the Volcker and Greenspan days, what Chair Powell cited was the chapter and verse of the staff handbook, which is to say, when you create a forecast, you put in fiscal policy as you know it and as current law dictates. You don't speculate about where potential policies may be. And when potential policies get put in place and you know where fiscal policy has changed, that's when you change the forecast. And the Fed has been doing that ever since the 1980s when I was there. And I don't think you should expect anything to change from that. Now, there's no chance, there's for sure that the staff is running a whole bunch of scenarios and alternative what-if scenarios just to give the FOMC a sense of range as to where the possibilities may run. But in terms of the baseline forecast on which they base their interest rate decisions, that fiscal policy will not be put in place until it's very clear what Trump wants and it's very clear what Congress is able to enact.
So, Bill, I guess until we're told explicitly, until we know explicitly what Trump's measures will be, can we assume at least, maybe to your point, that the Fed is still focused on a slowdown rather than a potential pickup in inflation at some point in the future?
Exactly. The Fed baseline forecast shows that inflation is trending down to 2%. GDP is growing well above trend. The unemployment rate has hit that sweet spot of 4 to 4.5%. And so the economy is cruising very, very nicely, and it's not going to do much. The Fed itself is not going to do much to try to disturb that. Now, markets may do something else, because I think the markets are reminding everyone the Fed controls the short end. It's the economy and the outlook that controls the long end. So what you're finding is what a lot of traders call a bear steepener. The long rates are going up while the short rates are coming down. And the steepening of the yield curve means that it's more of a normalization of where the yield curve should be. It shouldn't be as flat as it is now.
Bill, the question we're posing to our clients and our viewers, and I was hoping you could chime in, it's a very simple one on your point on yields there. Have yields peaked in this cycle, you think?
Tell me if inflation has peaked and if growth has peaked. In fact, I think that the normal long-term interest rate is going to be inflation plus a premium plus a real rate of about 2%. So add that together, and you're going to get somewhere in the neighborhood of 4 to 4.5% as a normalized long-term real rate. And we're pretty much there. If we hit 5%, it's only because inflation expectations have really breached and started to go up. And we're seeing signs of that right now in the 5-year, as well as the 5-year break-evens. Yeah. They've risen by about a quarter point. And if, as Chair Powell said, if it becomes entrenched, they're going to try to do something about it and prevent it by keeping rates high or even pushing it up further.
Bill, I know the Fed might be behind the scenes looking at what this fiscal policy is going to look for Trump. I'm wondering what you're thinking about when Trump has talked about blanket tariffs up to 60% on China.
Yvonne, I'm so glad you asked that question.
How inflationary could that actually be?
Yes, I hear so much talk right now, even among economists. Oh my God, the inflation that's going to come because of these Trump tariffs is going to be enormous, and it's going to be the end of the world. I have to say, if you look back on what's happened after Trump put in tariffs in 2016, and after Biden even widened those tariffs during his administration, what happened to the CPI? Nothing. The best studies show that the rise in inflation due to tariffs was about a quarter of a percentage point at best. And that's over a 3-year period. Now, you can say, well, we've got to get 100% tariffs, not these tiny little ones that we've had before. But I think one thing to remember is Trump is a businessman. Everything is negotiable. And I think you will see him say, okay, 100% tariffs on Chinese goods, And if you still continue to import them, I'm going to make them 200%. That's the first round. The next round is going to say, okay, what are you going to give me in return? Can you put jobs into the United States? Can you invest in the United States and create more jobs? If so, you escape my tariffs. And I think that's how the procedure, the process of negotiating will go. If you are able to bring jobs to the United States, you will be exempt from the tariffs. And it's almost as simple as that.
Bill, we can't look at tariffs in a vacuum. I think the president-elect has brought up tariffs in the broader context of things like tax cuts, for example. So let me ask you, if tariffs are not in themselves inflationary, what is, and we saw that in the last fiscal push, is fiscal spending. How much do you think spending goes up, number one, and do you think the budget blows out?
No question, we're going to be on an explosive budget deficit path. As Chair Powell said, where the debt level is now is sustainable. The path itself going forward is not sustainable. And with President Trump's spending agenda ahead of him, unless growth really picks up and pays for the rise in the deficit, which I doubt right now, because the kind of growth that we need is going to be enormous, we will see an explosion in the deficit. But explosion meaning from what, 4 or 5% to about 7 or 8%. The debt levels are projected to go up to about 120% of GDP. That's much less than what China has right now, for example. So, and much less than what Japan has. So in terms of whether it's manageable, it can be manageable over the next, say, 5-year horizon, but certainly it cannot be allowed to proceed as unrestrained, because that will signal the threat to the reserve currency status of the dollar, and also a lot of crowding out and high inflation to come.
Bill, since you mentioned China, I've got to ask you, there's a narrative out there right now that with a Trump win, that China's going to have to deliver a bigger fiscal package to boost its economy and offset the potential threat to tariffs. Do you assume that as we lead to the wrap up of this MPC meeting and what we could get out of this package later on today?
China's domestic economic outlook is really quite poor right now, despite the amount of stimulus they put in place. I think the reason why the fiscal stimulus hasn't worked so far is because it's really oriented toward the supply side. President Xi is absolutely convinced that higher quality production will produce higher income that will then stimulate demand. But I want to remind you, John Maynard Keynes in the 1930s said, supply creating its own demand is not going to work to get an economy out of a depression if the confidence in the economy isn't there. And right now, neither entrepreneurs nor consumers are confident enough to start spending. So I think that the President Xi really has to redirect the fiscal stimulus more toward the demand side and less emphasis on the supply side. I think this John Maynard Keynes told everyone, Say's law just doesn't work. Supply does not create its own demand.
Bill, it's great to have you. Thanks for wrapping the week with us. Bill Lee, Chief Economist and Executive Director at Milken Institute. And what a week it's really been. Still ahead, we'll be talking more about U.S.-China relations as Beijing gears up for Trump 2.0. Former U.S. State Department official Susan Shirk will share her views. And we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. The backdrop for stocks in China looks pretty good these days here. So we're seeing futures up 0.5%. This is the China Show. Well, China's MPC Standing Committee meeting is wrapping up today. And let's get to our Chief North Asia correspondent, Stephen Ingles. He's in Shanghai for us and joins us. Steve, what is at stake for Beijing with this stimulus package today?
Well, obviously, it's the growth outlook. And of course, the authorities in Beijing have been talking incessantly about meeting that growth target of around 5%. Of course, we had a raft of stimulus at the end of September. That was reflected in some of the October numbers that we got, in particular yesterday. The trade numbers were quite good, up 12.7%, but it did widen the trade surplus to a third highest monthly record, I believe, as imports also went down. That's going to exacerbate trade tensions, too. But again, with the prospect of trade tariffs from the United States upwards of 60%, That, spells a bit of uncertainty for the Chinese leadership and for the Chinese economy, which has been really relying on that main pillar of exports for right now, while property and consumer demand has been fairly low, if not in the doldrums, of course. So that big number, if we're going to get a big number today, is what investors are looking for. We've been waiting for this National People's Congress Standing Committee meeting that's been meeting since Monday in Beijing, because the NPC, the legislature of China, has to approve it. They have to vote on it and approve it. And again, the big question going forward is, how much stimulus are we going to get, and will that offset potentially next year the beginning of tariffs? We've heard guests, including our most recent guest, is that it's not a foregone conclusion that it's going to be a 60% tariff across the board under Trump on Chinese products. It could be negotiated down. But we're getting numbers yesterday. Macquarie's and Standard Chartered projected China's GDP growth could suffer a hit by as much as 2% if there is 60% tariffs. So again, that size of that number is probably part of Beijing's calculus, and what will be part of the announcement anytime this morning up until midday. We could get that announcement about not only details of the debt swap program and raising the debt ceiling, but also other stimulus that could help consumption and banks and property sector.
Yeah, and it really depends on how quickly these tariffs could be rolled out, right? Does it come in stages and the like? Steve, that certainly is a factor for Beijing. So in terms of specifics today, what are we looking out for?
Yeah, well, again, it will be details of that fiscal outlays, but probably the focus, because Xinhua News Agency had that press release on Monday that they started debating and talking about this raising of the debt ceiling and providing details of this swap program, essentially to get, the estimates are ranging between 6 to 10 trillion yuan. That's more than $1 trillion US dollars. Address that, swap that out so the local governments can use the cash essentially in other areas like employee salaries, construction costs, and the like. They've been paralyzed by their fiscal gridlock right now so far through the pandemic, the costs that were incurred, and essentially trying to deliver growth. That's important right now as we head towards the end of the year and meeting that target. So what Standard Chartered's Ding Shuang expects China to set an official budget deficit for 2025, potentially even at this meeting, of 4.8 trillion yuan. That's 3.5% of GDP, and also predicts, this is Ding Shuang, predicting that Trump's victory likely means the fiscal package that I talked about, in addition to the debt swap, could be about 2 trillion yuan more than earlier thought. So again, we're just waiting. This is going to be a busy Friday.
Yep, Steve, thanks for the preview there. Stephen Ingles there, our chief Malaysia correspondent. And Dave, as you mentioned, markets seem to have really moved on from all the noise that we got from the election, from this Fed meeting, and we're really focusing on what could come out of Beijing today.
Yeah, because there's certainly been a lot of buying taking place, particularly in the onshore market. The reason I bring this up is you look at turnover, right? In fact, even turnover overnight in some of the China proxies, volumes, I think, on KWeb, which is the China Tech Tracker ETF, also, I think, came in at the highest in about a month. The bond markets, we just showed you that yields are continuing to fall. So certainly there is a lot of positioning ahead of that fiscal push in the details of such. So 27 straight days now, we have been above 1 trillion renminbi as far as turnover goes. We took that out at the start of this major policy pivot, that massive move up. And even when stocks were actually trading in a range which we broke out of, by the way, on the CSI 300, turnover remained quite elevated. In the last 3 days, has actually seen that pick up even further. That's point number one. Point number two is, the notion that, and this is a big if, right? If we are, in fact, at the cusp of one of those multi-year bull markets in China, the next chart shows you this, some of the technicals do indicate that we're actually still in the early innings as far as this is concerned. What you're looking at here, it's a weekly chart. It's the fear and greed index, which effectively is the ratio between buying strength and selling strength. If it's in favor of the former, you tend to get a positive number. The opposite, of course, is true. And as you can see, the bull market in 2006, 2015, the one during COVID, and the one where we are right now, as you can see, we're in the very early innings, if, in fact, this is one of those bull markets. We'll see what happens here, of course. Fun.
Yeah, as you mentioned, right, there is some momentum behind this rally once again as we count down to this MPC meeting. And we talked about the CSI 300. We're set for the best week in about a month, really. And all hopes of further stimulus from Beijing seems to have outweighed a lot of concerns about potential Trump tariffs. Let's bring in our Asia equities reporter, Winnie Xu. She joins us now. Winnie, just tell us how we're set up here today.
Right, so the market sentiment is still really high as people are really expecting a big major stimulus to be announced today as we wrap up with the MPC meeting. And we saw that sentiment really improved in the past couple sessions. And the logic here really is that the tariff by Donald Trump potentially is going to raise lots of growth concerns in China. And that triggers the Chinese authorities to come in and to improve and to support the domestic demand. So that logic right there is supportive, and people are expecting the authorities to be more reactive than being on the proactive side when dealing with the relationship with the U.S. And the timing itself is also very interesting. When we talk to investors, they mentioned that we might not be able to see anything too much until the U.S. election wraps up, and that's exactly what we've been seeing so far. So what we're going to see today is going to be something quite exciting.
Well, I mean, the Hang Seng Index is already trading at 21,200. Winnie, any insights into sector preference and what that tells us maybe about the longer-term outlook here for this market?
Right. So in terms of the sectoral preference, we're seeing that people still right now prefer the domestic stimulus package beneficiaries, including the consumer sector and the property sectors. Those are the two key sectors that we really saw a rise yesterday. And that's going to continue to benefit as we expect more policies to come through. And these are areas that are less reliant on the exports or the manufacturing and are also less affected by the potential tariffs and the geopolitical tensions that's going to rise between China and the U.S. And in terms of the outlook right now, investors are still quite on the sideline in terms of because of the political risks and the geopolitical challenges that China is facing.
Winnie, thank you so much for just getting us warmed up this Friday. There's a full trading day left ahead of the weekend, of course. Winnie Xu, our Asia equities reporter. And on that point, futures and your pre-market pricing are both pointing to a higher open this Friday. The opening bell 5 minutes away. This is the China Show. All right, beautiful weather outside. Futures are pointing higher ahead of the open here. So the Fed cut interest rates 25 HKMA because we import monetary policy, also cut by a similar amount. Let me end on a positive note ahead of the opening bell here. The weather suggests we might get a T1 typhoon warning today. This typhoon that is hovering. More on that in a moment, plus the market open. Happy Friday. This is Bloomberg.
Welcome back. You're watching the China Show. We're counting down the open of markets. And it really, as we count down to the end of the week, we're really just focused on one thing right now, MPC, right? So, forget about the tariff risks and all that. Is that priced in, as UBS's James Wang says? And really, do we need to focus more on what this MPC meeting is going to bring in terms of more stimulus or not, Dave? Yeah,
I think that's a really good way of putting I think in some ways some of the factors that policymakers in China need to consider, right? So in some ways, if you're in the market, you price in all the way to 60% and then you work your way back because we don't know eventually what that final number looks like. And I think from policymakers, what is the policy offset you want to announce this weekend? Or do you save some of that because that's a fluid concept as Donald Trump goes on, of course, and lays out really his stance. And, the notion that it's a starting point of 60% because it's a negotiating tactic might be a separate conversation. But certainly, to Yvonne's point, right, so elections is number one. Number two is, you look at the NPC, and we've broken out, and again, across the board, across the board, every single sector is up in China. 4,200 now, 1.3%, 3% rally yesterday. We now know what the big story is today with this open here. So we'll see what the details look like in terms of sectors to watch. And we could be basing it on the price moves yesterday. So companies that would benefit from the rally tend to do better short term. So insurers, for example, we've already seen that happen. Brokerages, some of the consumer staples, the liquor makers did very, very well yesterday in, again, very heavy volumes and very heavy turnover. So consumer staples, that's one to watch. And as you can see, maybe it's a little bit different today as far as price action in the early goings is concerned. Small caps, though, as you can see, are still doing very well, did very well. I said the 3-4% on the Chinese index were up 2% in the early goings. It's very early, though. Let's have a look at Hong Kong, please. And it's a separate story because, again, the relative trade within China has so far been A over H shares, meaning A shares have outperformed H of late. In fact, it's really where A shares have broken out of the range, not so much yet on the Hang Seng Index and Hang Seng China Index. Now, look at this figure. Look at that figure. And look at the two figures coming up bottom of your screen. So you compare those and where we are, where those two are coming up. The reason those two are important is those were the closing highs early this week. Beyond that, I think can we show that, please? Above that level, we would then look at Hong Kong as being able to break out of this range. So just watch those levels very closely, 21,260, 21 right. If we close above that, so we didn't manage to close above that yesterday. Anyway, lots to consider as we look ahead to today. As you can see, some of the heavy weighted stocks here are doing very well. And we'll wait to really see what the other movers will be in this market. It's very early goings. But yes, the rally is set to continue and Hong Kong is set to snap out of this 4-week losing streak. Yvonne.
Yeah, it looks quite broad-based here right now. Let's bring in our M-Line strategist, Mark Cranfield, joining us. And Mark, Dave highlighted under the hood, you're seeing so much activity across this market here right now and so much anticipation of what we could see from the MPC. What are you looking for in particular to suggest that maybe, possibly, this rally can continue?
Well, one thing for sure is investors will want to see that China doesn't take their foot off the gas. So one thing is, obviously, we're expecting to get some impressive announcements, some very big numbers, particularly on the debt swap that people have been talking about into the local government area. But it's really about where they go in the next few weeks as well. It can't be a one-off event. There'll have to be consistent reminders to investors that China are going to deliver. They're going to keep on doing this until they see the sustained growth that they want and that the inflows that they want to see in terms of the equity markets coming in from foreigners as well and locals, but especially from the foreign markets as well. So it's a very good start. It's encouraging. If you look at the CSI 300, for example, the high volumes have sustained from the end of September when we had the huge breakout in the market. Although it dipped slightly in October, we're seeing this is probably going to be the best week for the CSI in more than a month. And it's being built on very solid high levels of volume. That means that fresh money is coming in. People are going with the flow for the time being. They believe in the story that whatever China can deliver in terms of stimulus is going to be more important than the risk of the tariffs, which may or may not come to China in the months ahead. But it's a story that they can't afford to back off of. We've seen so many times this year when you get a one-off announcement and then nothing and the market loses interest and we've seen the stocks fall back down again. They cannot afford to do that again. There is so much at stake and there is so much hot money that's come into the Chinese market. It could exit pretty quickly if they're not convinced that China is going to push well into next year, keep on supplying the stimulus and keep on talking up the market as well.
Yeah, Mark, and at some point, it's a dilemma really that policymakers are faced with because what else can you offer the market that you haven't said already? And I guess the reason I bring that up is because for example, we get a big number this weekend. We go into next week, and I'm looking at the calendar for next week. So you have activity numbers coming through, and you have the big tech earnings, Tencent, Alibaba, pick your big tech company. Can those, you think, act as the catalysts to bridge this gap between announcements from policymakers, you feel?
Certainly, the earnings of the big tech companies is very important. People will take a lot of comfort if they see decent numbers, and more importantly, if they see a positive outlook, if they see those companies looking ahead into next year and saying that they can sustain the kind of growth and the numbers that they're showing now, that will be even more important. And as you say, earnings in general. So this current, or the earnings season that's just finishing in China has been a very poor one. So it also will need that the next earnings season, there's a lot resting on that as well. Money could leave the market pretty quickly if we get a second bad earnings season. So we really need to, again, the build up into the earnings season in the first quarter of next year has to be a very strong one as well. We need to see results. But yes, the tech sector is a major part of it. And if we get decent numbers with good outlooks, that will help a lot as well.
Mark, thank you. Mark Cranfield there in Singapore for us, our MLive strategist. You can follow more on the story and all the day's trading on our Markets Live blog. Of course, Mark and his contributions there, of course, part and parcel to the narrative that we, of course, talk about daily here at Market Rundown. MLive you go for our Bloomberg clients. You can check that out, commentary and analysis on your screens. And I think this was the very specific one Mark was talking about, their volumes and turnover remaining on the up. Right, plenty more ahead. This is Bloomberg.
Well, time for Trending in China. Look at what's making headlines in national newspapers. And as the NPC Standing Committee meeting wraps up in Beijing, the Securities Times is playing up the impact of recent stimulus measures and saying that they've boosted the capital market and investor confidence. The paper cites an increasing number of firms applying for the PBOC's facilities for share purchases and buybacks, as well as a pickup in M&A activity. Speaking of the capital markets, the PBOC-backed Financial News is reporting on comments from the vice chair of the China Securities Regulatory Commission, or the CSRC, Li Meng, reportedly told a Shanghai Stock Exchange conference that regulators will continue to back the opening up of markets while maintaining a stable and predictable institutional environment.
Now, looking at geopolitics and President Xi Jinping's congratulatory message to the U.S. President-elect Donald Trump is on the front page of the People's Daily. While the front page piece is quite brief, a longer commentary on page 4 actually expands on the key message there coming out of the Chinese president. Now, the party's official mouthpiece also calls for stable China-U.S. relations, saying it's in the common interest of both countries. Employing some of Beijing's favorite buzzwords, it says things like mutual respect, peaceful coexistence, and a win-win cooperation should be the foundation of the bilateral relationship.
And more, of course, on the U.S.-China relationship now under a second Trump presidency. Let's bring in Susan Shirk, research professor at UC San Diego School of Global Policy and Strategy. She previously served as a U.S. Deputy Assistant Secretary of State for East Asia and the Pacific. Susan, it's great to have you back on the program. When you talk about Trump 1.0 and how Trump 2.0 could differ, obviously we've heard of this threat of up to 60% tariffs on China. Do you think that this Trump and the President-elect Trump is now going to really deliver on these threats? What's the most plausible scenario now?
Well, I think it's entirely conceivable that he says he's prepared to impose tariffs, draconian tariffs of up to 60%, but that he uses that threat to open up a negotiation to try to do a deal that addresses the trade gap and the problem of overcapacity. He's a transactional guy. He prides himself on his ability to do deals. So if he starts by inviting China to make a deal, then I think, there's a chance. And I think China is actually potentially quite interested in that, because for the past 2 years, it has been using diplomacy to try to stabilize relations with the United States. And I think it would much prefer to sustain that effort, especially when it has so many pressing domestic problems and its economy is struggling.
Susan, maybe just to pick up on that, what do you think China would be prepared to give in to, for example, if in fact concessions are on the table so as not to not to see 60% tariffs imposed on their exports?
Well, if the focus is on overcapacity and depending on exports rather than domestic consumption and demand to revive their economy, then they could follow the Japanese model of promising voluntary export restraints. They could drop the tax rebates for exports and at least acknowledge that their economic model has created a lot of negative externalities for other economies. And I think that's the start of a negotiation. The negotiation could extend to the opportunities for Chinese companies, including electric vehicle companies, battery companies, to invest in the United States. Remember, Donald Trump welcomed foreign companies, including Chinese companies, to invest in the United States. Let's see whether or not he's serious. But if you're going to do that, then the early days are very important. You can't start off with a completely hostile approach. You have to set the table for negotiation.
Yeah, I was going to ask you, back in 2016, when he became president the first time, we didn't quite see these tariffs roll out or things heat up until maybe 2018, and then it was maybe 2 years later that we saw some sort of deal. Given the fact that Beijing has been here before, are we likely to see maybe faster negotiations, better deals being made here, given the experience that Beijing has had in some ways? My question really is, do you think we'll see, how quickly can these tariffs actually roll out?
Oh, I mean, there's no rush on rolling out the tariffs. I mean, you can hold up the threat of the tariffs in order to get a negotiation started. I mean, that's making strategic use of tariffs. They could even make strategic use of tech restrictions as well. And the goal could be not just to get China to revise its economic policies, but it could even extend to Chinese foreign policy and its behavior in the South China Sea, East China Sea. I mean, I'm a fan of negotiations, and when I worked in government, more than 2 decades ago, we used the threat of sanctions in order to induce changes in Chinese policies. And at that time, it was mostly focused on nuclear and missile proliferation, as well as on economic policy with the WTO negotiation. But my point is, our policies so far have not been terribly effective at giving China incentives to moderate any of its policies. And I think it's conceivable that Trump might be a president who actually succeeds more in negotiating in this way with China.
Susan, do you think, and who knows what China might be open to discussing as far as concessions go, but do you think on the American side, do you think Donald Trump would be open to loosening America's tech restrictions, current tech restrictions on China? Is that on the table, you think?
Well, it's definitely not on the table now, and I don't think it will be on the table for quite some time. But, we should start off with very concrete objectives related to overcapacity, exports, and China exercising restraint over those exports and trying to stimulate domestic demand. But the thing about negotiations is that if both sides feel that they're benefiting from mutual compromise, then it can build on itself and it might extend to other geopolitical issues as well. And what we need to do, though, is we can't start out with a completely hostile rhetoric and hostile attitude. That we have to show that the door is open for that kind of mutual accommodation that would be good for both sides.
And Susan, maybe the good way to end that is, do you foresee some sort of meeting between President Xi and the President-elect Trump anytime soon then? Could we see that as soon as next year, maybe?
Well, I expect that the Chinese will be sending someone over to consult soon, get and have informal discussions with the incoming president, and that, you know, I would advise President Trump to suggest leader-to-leader meeting occurring very soon, and not just at the margin of other international multilateral meetings, but in Washington or Beijing as well.
Susan, thank you so much for your time and for staying up. We appreciate the conversation and your insights. Susan Shirk, research professor at UC San Diego School of Global Policy and Strategy. Now, Trump's re-election also puts the spotlight on the ongoing tech war, as we were just pointing out there, between U.S. and China. Bloomberg Originals takes a look at why he may be facing a losing tech battle with Beijing.
It's official. Donald Trump has been elected President of the United States.
Donald Trump's first presidency gave Washington a playbook of hardline tactics for preventing China from overtaking the U.S. as the world's dominant economic and technological power.
Trump introduced punitive tariffs on China, as well as trying to rebalance the trade deficit to try and contain China's economic rise, as well as trying to contain its military might.
To me, the most beautiful word in the dictionary is tariff.
Trump is focused on raising tariffs to prevent China from shipping many of their goods into the United States that perhaps are subsidized by the government.
And his campaign for re-election left no doubt that his ambition for American supremacy was still his North Star.
We will hire American, buy American, build American, grow American, and show the whole world that the American dream is back.
But after 4 years out of the Oval Office, Trump is returning to face an emboldened, savvier China, and one the U.S. may already be losing its battle to contain.
They've been very aggressive in applying for patents that they think are going to help them develop domestic industries that are critical to their future.
Ultimately, there is this idea that trade always gets through. And that's sort of what we see when we think about the EV industry in China.
Tackling that is likely to be one of Trump's primary plot lines in the sequel to his first 4-year showdown with China.
And subscribers can see that report in full on the terminal or at Bloomberg.com, and it'll be on Bloomberg Originals' YouTube channel later today. And later on in the China Show, we're discussing the implications of Trump's election win on the chip sector with analysis from Neuberger Berman. That's in our next hour. This is Bloomberg. Some major corporate stories that we're following for you this morning. OCBC has reported net income for the third quarter that beat the average analyst estimate. Profit rose as its trading performance and gains from wealth fees and insurance cushioned a dip in lending income. Fellow Singaporean lead lenders UOB earlier reported higher than expected earnings for the third quarter, also driven by record fees underpinned by wealth management. Nippon Steel says it still expects its acquisition of U.S. Steel to be completed by year-end. Vice Chair Takahiro Mori says discussions can be constructive now that the U.S. election is over. He is hoping to visit the U.S. this month and meet with union leaders. The $14.1 billion deal has faced opposition from unions, and President-elect Donald Trump also said he would block it. And Nissan shares tumbled to 4-year lows after the company cut its full-year operating income guidance by 70%. The Japanese automaker will cut 9,000 jobs and reduce manufacturing capacity by a fifth as it struggles to cope with tougher industry conditions. The ugly results are proving costly for the CEO, Makoto Uchida, who's forfeiting half his compensation starting this month.
Yeah, well, let's start on the car theme here, because going the opposite way is XPeng in Hong Kong. We're up 20%, which is the biggest jump, I believe, since the summer of last year. So this is a 12-plus month move here. So the company effectively cut out the price on its P7 Plus model, and the starting price that, according to Morgan Stanley, actually coming in above, well, beating expectations is how they phrased it. Let me just rephrase it more simply. The starting price is cheaper than the market expectations of 190 to 200,000 was the estimate. This one coming in at about 187,000 renminbi, which is actually not very expensive.
No. Take a look at. Well,
I know some wines that are more expensive than the car.
But yeah, they said basically it's
not my wines, but
it's a price parity with other battery electric vehicles within the similar vehicle class, like the BYD Han BEV, for example, according to Morgan Stanley. So yes, you are still seeing that price competition there. Casinos are watching very closely as well here. Take a look at when it comes to Wynn Macau. We're seeing gains about 2.5%. Galaxy really extending that rally, of course, after we saw those third quarter results beat Citi's estimates according to their projections as well. So yeah, that's still looking pretty good. You take a look at how markets are set up and how we're looking at maybe just about 20 minutes into the trade, and we continue to see a broad-based rally there. Hang Seng up more than 1%. You're watching the China Show. Welcome back to the China Show. Here's a look at the HSI a half hour into the session. And yes, plenty to look ahead to in this market here today. Take a look at HS Tech. We're up some 2% right now, 1% gains for the Hang Seng. And we are basically on course to break out of this 4-week losing streak when it comes to Hong Kong stocks. So what's driving that? It's not election. It's not really the Fed. It's really about what we can see in the next few hours here coming out from this NPC Standing Committee. And there's a lot of optimism that maybe even after a Trump win, we could see something bigger when it comes to a fiscal package, Dave. Yeah, well, it depends, I guess, on what eventually comes of his threat of tariffs and what kind of sort of offset that China needs to put in place. And I think to the point of Mark Cranfield, that is such a long way away that markets will need to get something short-term consistently from policymakers in China and data and earnings and what have you to continue the bull market, right? Yeah. And, markets have run up actually quite decently this week. They've reawakened, if you will. I think the price on HS Tech Index 2.2, volumes have picked up. Some of the low-hanging fruit like brokerages, insurers, consumer staples led the rally yesterday. So those would be the stocks to watch, whether or not that continues. I think we also have, in fact, if I could just maybe flag this, I think we have a chart on put call options to get a little bit fancy this Friday on one of the large cap ETFs in the U.S. because that will actually show you that fund managers have actually maintained their bullish exposure to China even amidst this period of consolidation. The banks are doing this ahead of the NPC. Obviously, debt swaps very much in focus there. We're looking at dollar China as well. Let's have a look at where we are there, because it's really at the dollar story and the pickup massively midweek and the pullback into where we are currently at 715, 21 against the dollar. I think we have the put call chart, if that is ready ahead of this NPC meeting. And when we look at the rest of the region, Asia ex China too, let's look at that first. Yeah, here we go. Thank you so much. So what this shows you is options traders on the iShare China large cap ETF have actually maintained their bullish position, so I guess they haven't completely reversed their bearishness and put in the hedges, even amidst the resurgence of the U.S. bull market, I guess is the other point that we want to make there. Yeah, I mean, it seems like at this point, a lot of tariff risk might be priced in. And I think there is this lingering kind of assumption, right, that if we're going to see tariffs, then, President Xi might be forced to bolster a bit more domestically, whether it comes to consumption. I think Goldman Sachs says, he has no choice but to only stimulate this. And this is really what Bill Lee from Milken mentioned, right? It has to be demand side sort of stimulus this time around to keep this momentum going in some ways as well. Asia ex-China is looking like this here. The rest of the region looking pretty good, obviously, given that we saw the dollar kind of soften a little bit post-Fed. So did Treasury yields here. So certainly that helps the whole backdrop for equities here today. We're up about 0.6%. And yeah, we're seeing a little bit more gains here when it comes to Taipei, for example. We're up to 1% here this morning. But really, it was a pretty modest sort of reaction to the Fed. Really no surprises there.
Yeah, which I guess is a good thing, right?
Yeah.
I think we've had enough of a week of
volatility
in emotions and markets, and we're not done because China wraps up, of course, the big meeting in Beijing today. And going into tomorrow, we have inflation numbers coming through out of China, and the next week is a big week as well, as far as the China story goes. In fact, let's have a look at Chinese lawmakers. Of course, they're getting a head start ahead of the U.S. elections this week as they gathered. Of course, they started on Monday to maybe prepare the largest fiscal package to support this economy since the pandemic. Now, that NPC Standing Committee meeting is due to wrap up later this Friday. Stephen Engel, our chief North Asia correspondent, is in fact in Shanghai for us now to talk us through this. Steve, what is at stake here with the stimulus package, especially now we know who the new U.S. president's going to be?
I say let's get on with it, right? I'm having stimulus fatigue myself just talking about it, right? Of course, the markets have been on tenterhooks about what's potentially going to come out of that National People's Congress Standing Committee meeting that does wrap up today. Started on Monday. Xinhua News Agency talked on Monday, essentially, that they spent a lot of that time in the early part of the meeting talking about potentially raising the debt ceiling, and then that would help pave the way for this debt swap program to essentially clean up a lot of this bad debt, to the tune of, the economists are ranging between 6 to 10 trillion yuan of hidden off-balance sheet debt via the local government finance vehicles, the LGFVs. That would help, lift the constraints, the fiscal constraints at the provincial level, and then, of course, increase spending for much needed areas that they've been paralyzed following COVID-0 and of course, the slowing Chinese economy and the absolutely pulverized property market. So that's the backstory. So what are the numbers going to be? We simply don't know. Lots of speculation, but we did hear essentially from Ding Xuan at Standard Chartered saying because of the Trump factor this week and the potential. Again, we're not saying that he's going to do 60% across the board tariff increases on Chinese products into the United States. It's probably, as all of our guests have been saying, probably going to be negotiated down in any kind of trade negotiations once he becomes president and starts talking about those tariffs. But still, we could see essentially 2 trillion yuan, according to Ding Xuan of Standard Chartered, more of fiscal stimulus from this package than previous what we knew prior to Trump being elected. So that's, again, this whole Trump tariff factor has to be factored in. But will it come all today in one big bazooka, or will it be a piecemeal approach like they've done in the past? We have 2 other meetings coming up next month. We have the Communist Party Politburo meeting in December. We have the Central Economic Work Conference also convening next month. And then there's speculation that any kind of even debt swap program or any of this fiscal stimulus that could help bank recapitalization, consumer confidence, and the housing sector could be spaced out over several years. So the market has a lot to digest.
Yeah, can you get through that wish list a bit, Steve? I mean, what could actually continue this rally that we're seeing across markets here? Is it the local government debt swap? Is it more consumption measures? Or is there still people still really wanting more stabilizing measures here on the property market?
Yeah. Well, we've been talking about it so much, and I heard Garfield Reynolds talk about it earlier. He said this could end up being a sell the news event, given the run up in the CSI 300. It's up 6.5% this week. despite the turmoil coming from the U.S. Presidential election, all on stimulus. So again, they kind of have to, the expectations are so high, they have to kind of, wow, do they not? But if they kick it the can down the road, that might be a sell moment for the markets because it's run up so much. But again, that debt swap, we could be seeing, alleviation between 6 to 10 trillion yuan of that hidden debt. The estimates that I've seen are $8 trillion total of hidden debt at the provincial level. So this would be a step in that direction. Also, housing market stabilization. Could there be some funds there? Could there be a bank recapitalization? Could there be support to boost consumer demand? Because at the backdrop of this, guys, is if the export situation drops off dramatically. Let me give you some numbers. If this Trump 60% tariff does get into play next year and beyond, Standard Chartered says Trump's tariff plan would likely reduce Chinese shipments to the U.S. by up to 70%. 70% within the first year. Total exports from China would decline about 8%. That would be about a 2% drop in GDP in China. So who has to pick up that slack? Yes, fiscal stimulus from the government, but the consumer has to start spending. Those products that China makes has to go somewhere. Domestic recovery will be the focus as well of this stimulus.
Yeah, and Steve, while we wait for the consumer to spend, you're there in Shanghai. Why did you do the heavy lifting? Whip out the credit card, Steve. Go big, as they say, going into the weekend. Stephen Engel, Chief
I bought a new jacket yesterday, okay?
Nice.
Oh, there we go. Retail sales are out next week. That's going to show up there in those numbers. Stephen Engel there in Chicago for us. Still ahead here on the China Show. Neuberger Berman joins us to talk us through tech, AI, and all of the key themes there. The outlook, of course, for U.S. chip policy under the incoming white Trump administration. Now, going into the break, we're looking at a rally across Chinese markets coming off highs on price. Although here's an astounding statistic yet again, 35 minutes into the session, and yet again, we've topped the 1 trillion mark on turnover, and we're barely into the morning session. Plenty more ahead. This is Bloomberg.
Recent indicators suggest that economic activity has continued to expand at a solid pace. We got one inflation report, which it wasn't terrible, but it was a little higher than expected. We're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points, and we're asking ourselves, is that where we need to be? We're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves.
There you go, Fed Chair Jay Powell there on the rate path outlook. Didn't really give much away on what they're going to do post-November in this election. So December is still probably something they said, we're not going to rule anything out or in right now when it comes to that next rate cut. Let's bring in Pauline Chrystal, portfolio manager at Kapstream Capital. Pauline, I'm just wondering what it's been like for you, this whole volatility we've seen in the MOVE index and the bond market. There's this push and pull between the Fed cuts, and then, of course, now we're talking about Trump's return to the White House. What's going to be driving these Treasury yields moving forward here for the next few months?
And Yvonne, there's no doubt that there has been a lot of volatility this week, and we've seen yield curve move higher across the whole curve. It's not a surprise when you think about a Republican win and a Trump win, especially since if he wins the House as well as he's won the Senate, it will be a lot easier for him to pass the policies that are pretty much what we would expect and some of the electoral promises that he's made. So that means higher fiscal stimulus, higher budget deficit, potentially supply and demand-driven inflation, supported by tariffs. And, he said that tariffs is his favorite word. So, the rise in yield is not very surprising.
But the question is really about how much higher can that go, and really the reprice in the terminal rate, is that a fair reprice or not? But it's a little bit too early to tell. And we saw Chairman Powell last night's comments were very neither here nor there and very cautious, didn't give anything away. And that's because it's a little bit early to assess the impact of a Trump win on the economy and the long-term impact on the rate curve. So there was an initial move, which we thought was fair, but we won't be able to tell how much more that's going to reprice until we see those policies starting to come into effect.
Yeah, but Pauline, I'm glad you brought it up, because we asked that question to our guests in the last hour or so. Has anything structurally changed on inflation expectations? And I think what he said was yields are probably at the peak of the cycle, but watch for things like break-evens that might indicate that markets are rethinking where the neutral rate is. What would tell you convincingly that there has been, in fact, a change in market expectations around inflation because of Donald Trump coming back in?
And look, that's a really good question. And, I can't give you a really firm answer. I don't have a crystal ball, but things that we would be looking out for is the size of the fiscal package that he's trying to push through. We want to look at things like tax cuts and work out the impact of the spending, the impact of stimulus, and how that's going to affect budget deficits. But the other thing that we want to keep in mind as well is that while in the short term, yes, that will push the curve higher and your terminal is going to be higher, but in higher inflation, for example, that might, in the medium term, slow growth down. So while maybe in the first year or so you will see an uptick in growth, the medium-term outlook is a little bit more uncertain.
Yeah, we were just thinking that this is going to be the crystal ball. That should be what your reports should be called, Pauline. But I got to ask you, you mentioned it's hard to kind of calculate and quantify that sort of, debts and deficits and where yields will go. So the question today we're asking all of our guests is really, have we seen a peak when it comes to Treasury yields in this cycle? I mean, you're hearing more and more people say, look, it's starting to look a little bit more attractive where we are right now in terms of these levels.
Yes, it's definitely more attractive, Yvonne, and it's a good tailwind for fixed income. And it's no surprise that we've seen a little bit of spread compression as well, which, when you think about that in the context of what's happened this year, you're looking at U.S. corporate spreads. That's tightened about 45 basis points before the election, and that's tightened even further since the election result. And the reason is just because all-in yield remain quite high. And if you're an all-in yield investor, such as a retail investor, for example, you will want to lock that high yield in. So there is, and there has been, and there probably will be a little bit more demand for fixed income assets. So that's, despite all the uncertainty, that's one factor that we're pretty confident about.
Yeah, and I think where you want to be, based on some of your talking points here, is you think AUD credit offers the best value. Pauline, I got to ask, are you just saying that because you're there? Just, just elaborate that idea for us.
Yeah, look, maybe I'm talking my book, but really, when you think about the first point I made around valuations, you're looking at spreads in the US. We are the tightest levels since GFC, and remember that even though we started the easing cycle, there's still 500 basis points of rate hikes in the system. So, valuations are really tight in the US. Then you're looking at other jurisdictions and other regions, such as Asia. And Steve Ingles, just before I was listening to him, was talking about the uncertainty around the stimulus. And yes, there is a lot of uncertainty here. How is China going to react to the Trump election and potentially much higher tariffs? That's very uncertain. So that will bring in more volatility. So do we really want to invest in a region where we know there will be more volatility and where levels are tight-ish? It's a bit of a risk. And therefore, when we look at Australia, which is fairly insulated from what's going to happen in APAC from a tariffs and a trade tensions perspective, as well as valuations that are just slightly below long-term average, that makes it look a lot more attractive from a relative value point of view.
Pauline, we were talking about the MOVE index in the beginning, and let's wrap up with that as well. Just given the volatility we've seen, we're still quite elevated when it comes to that MOVE index. I pair that with the VIX that basically has collapsed since this post-election and Trump win. How do you make sense of these two things when an equity market continues to rally to record highs and a bond market that seems to be fearing a lot right now?
Yes. So no, the equity market, the collapse in the VIX is correlated to the run-up in S&P. And, it is a very consensus view, and that a view that we agree with, that equities will be very well supported by a Trump administration, in particular if he wins the House as well as the Senate, and it's also his last mandate, his last term. Unless he manages to somehow change the constitution, he cannot run again. So you would think that he would want to implement market-friendly, stock market-friendly policies, and that explains the very strong performance in the S&P and the drop in the VIX. Now, from a rates perspective, as mentioned earlier, there is a lot of uncertainty, and that means that there will be a lot more volatility. Is that now, have we reached the peak? Is there going to be a lot worse in terms of budget deficit than expected? We're not really sure. Or is Trump going to pull back on some of his promises? We're not really sure, and therefore that volatility is expected to remain fairly high.
Pauline, have a great weekend ahead. I was about to say week. It's Friday. Soon before long, we're going to be on Monday. Anyway, Pauline, have a good weekend ahead. Pauline Chrystal there, portfolio manager at Kapstream Capital. Plenty more ahead. We'll get you guys an update of some big moves in this market across the region. Stocks like Nissan, Genting, UOB, and others are moving quite substantially. We'll tell you why next. This is Bloomberg. Welcome back. You're watching the China Show. Now, Bloomberg has learned or has been told that Baidu is set to unveil a pair of glasses with a built-in AI assistant. Now, this would put a Chinese rival to the Meta Ray-Bans that, of course, have proven a rare success in the AI-powered hardware. Let's discuss this with our tech reporter, Belle, who's here with us. So what do we know about this product?
Well, it's a really interesting development, and this is sort of the hardware side. If you think about what's happening in China's AI space in general, and one of the key themes that's developed out of that is that consumers in China are not willing to pay for AI services that much. So the monetization prospects have been quite difficult. This is one of the ways that Baidu can try and make money in this space, by integrating AI into various sets of hardware. And so this is sort of the way they're going about it. So Baidu's World event is happening next week in Shanghai, and that's where sources are telling us we're going to see this product being unveiled for the first time. The glasses, they're sort of being compared, of course, to Meta's ones. They're the best known in the space, but Meta does have its own sort of Ray-Ban versions that they introduced a couple of years ago. They've been slowly building out the features, but these ones could have the capacity, for instance, to take photos, videos, and then they'll also be integrated with Baidu's search or ChatGPT equivalent, which is called Ernie, and that would have that voice interaction support as well. But it is an interesting time for the company, given that we've actually seen Ernie being pushed out from the #1 position for chatbots within China. ByteDance's equivalent now has the top spot. So it is, again, just trying to get that money out of it and continue to try and maintain a market lead in the space as well.
Yeah, I mean, especially, we were just talking in the break. I bought those Ray-Ban sunglasses.
And Yvonne's been burned, everyone.
I haven't really used them in Hong Kong.
She got Ray-Banned.
They won't let me use the app here. So, I mean, there's a bit of window, I guess, for Baidu to actually catch up in this market. I'm just wondering, what in terms of the expected sale?
Well, you don't have to wait for long. If you're disappointed you can't use the Meta ones, these should be going on sale sometime early 2025. And actually, the price tag could be better than Meta's as well, because they're on sale for $299 US. These could come in for less than that. And we've also seen, of course, there's that competition, we're not really talking about the US players, but within China as well, there have been a number of hardware hardware makers that have came out with their own AI glasses. Apple as well is looking at a push into this category. But the business division that's responsible for making these at Baidu, this is the hardware Xiaodu. It really does have a certain pedigree in this space as well. I mean, it's valued last in 2020 around nearly $3 billion US. They've already got experience pushing out voice-activated speakers, for instance, wireless earbuds. These all connect to the Baidu ecosystem. So that's where that product, we are expecting it to be released from. As we said, those glasses perhaps being unveiled next week.
Oh, very exciting. All right, Belle, thank you.
You know what to get you for Christmas, Yvonne.
Yeah, I got to get rid of the other ones first, maybe. We'll see. Someone will take it.
Hand them over.
Yeah. All right. Well, thank you. Let's do a market check here right now. We're looking at Nissan shares. The car makers are, you're seeing a big move in Nissan after they talked about cutting their guidance. They're cutting 9,000 jobs as well. So it was a pretty nasty sort of a report there. And you're seeing shares down some 6%. And Xpeng is the opposite story, right? The pricing of this new EV, quite competitive. And really kind of aligning with a lot, and maybe surprising even some of the market there, but just how close it is in price to some of the rivals out there, like BYD, for example. Here, I forgot what the name of the model was, but we're up some 18%.
I think it's P7 Plus.
Yeah.
Plus sign. Don't spell it out. Yeah, not phonetically. Yes. Anyway, go find your P7 Plus for $25,000 US. I think is the price for that. Genting Singapore, we're down about 5%. So company earnings coming in underwhelming, and we're also getting some commentary from analysts. JP Morgan and Morgan Stanley downgrading the stock. JP Morgan downgrading the stock to neutral. Morgan Stanley downgrading to equal weights. We're down 5% in Singapore. Plenty more ahead. This is Bloomberg.
11:29 a.m. in Tokyo. Japanese markets are going into that lunch break in just a moment, and you take a look at how we're doing across these markets, and we're doing quite well, decently so. We're up about 1/5 of 1% for the Nikkei 225, 153. So, we are seeing a little bit more strength, I guess, we saw overnight after that Fed meeting when it comes to the yen. Dollar softened just a bit here, but not a whole lot to really talk about here as we wrap up the weekend. And you take a look at the rest of Asia, it seems like things are still looking pretty good right now, Dave.
Yeah, we're trading at 191 on the benchmark, including Japan, 0.7 of 1%. I think we're up almost every single day this week, with the exception of Wednesday. In terms of the losing streaks, we're set to snap a 5-week skid on the Asia-Pacific benchmark. The S&P, of course, has been, well, that's a different story. Of course, it's been hitting new highs. In fact, there we go, 6,000, right, on S&P futures. As far as sector breadth is concerned, just about every single sector is up, with the exception of energy. The China story is a separate one, of course, as we look ahead to the breaking out of the current range and some of the earnings which have come through recently. SMIC, I believe, came out early today, and we're looking ahead to some of the big tech earnings later next week, and we're still waiting details out of the NPC standing committee meeting. In fact, the Biden administration is racing to complete the CHIPS Act agreements before Donald Trump takes office. In fact, sources tell us some companies, including Samsung, Intel, Micron, are still working through details of their contracts. Meanwhile, you have TSMC and GlobalFoundries are said to have wrapped up some of these negotiations. Now, the CHIPS Act has attracted commitments from different firms to spend around $400 billion to effectively put up and increase U.S. capacity, onshore capacity within the U.S. there.
And Trump's reelection has put the spotlight on the ongoing tech war between the U.S. and China. Bloomberg Originals takes a look at why he may be facing a losing tech battle with Beijing.
It's official. Donald Trump has been elected President of the United States.
Donald Trump's first presidency gave Washington a playbook of hardline tactics for preventing China from overtaking the U.S. as the world's dominant economic and technological power.
Trump introduced punitive tariffs on China, as well as trying to rebalance the trade deficit, to try and contain China's economic rise, as well as trying to contain its military might.
To me, the most beautiful word in the dictionary is tariff.
Trump is focused on raising tariffs to prevent China from shipping many of their goods into the United States that perhaps are subsidized by the government.
And his campaign for re-election left no doubt that his ambition for American supremacy was still his North Star.
We will hire American, buy American, build American, grow American, and show the whole world that the American dream is back.
But after 4 years out of the Oval Office, Trump is returning to face an emboldened, savvier China, and one the U.S. may already be losing its battle to contain.
They've been very aggressive in applying for patents that they think are going to help them develop domestic industries that are critical to their future.
Ultimately, there is this idea that trade always gets through. And that's sort of what we see when we think about the EV industry in China.
Tackling that is likely to be one of Trump's primary plot lines in the sequel to his first 4-year showdown with China.
And our subscribers can see that report in full on the terminal or also on Bloomberg.com. It'll also be on the Bloomberg Originals YouTube channel later.
Today?
Today. Okay, yeah, I'm trying to get it's Friday. Right. Chip stocks, we talked about some of the earnings coming through, 5% to the upside there. We were up as much as 7.3%, of course. Third quarter net income missing estimates. You have higher interest expenses. You have FX losses. That's according to Goldman Sachs. And yeah, some of the big chip plays across the region here on the back of this resurgence in Mag 7 and NVIDIA, again, I believe is now the world's most valuable company, retaking that top slot, I think, this week. Anyway, to talk us through how the chip conversation changes potentially under a Trump White House, let's bring in Boon, or YT Boon here, thematic Asia head at Neuberger Berman. Good morning, and thanks for taking time to come in. So, broadly speaking, how do things potentially change under Donald Trump as it pertains to the U.S. chip policy?
Yeah, I think the U.S. has been accelerating the onshoring or the reshoring of the semiconductor industry, especially on the manufacturing front. Yep. With, I think, under Trump 2.0, the onshoring trend will continue, but it may end up with a slightly different form as we know it, like the CHIPS Act is, finally coming to the end of its phases, and, everything's rushing through before Trump comes in. There's a chance of some changes there. We don't know what is going to happen, but what's for sure is these, or what we call the globalization of the semiconductor industry now is finally taking place, given the strategic importance of this industry.
You talk about where it has evolved, right? Obviously, we'll talk about China in a moment, but it's the Taiwans, it's the Koreas, it's the Japans, this golden triangle per se. But tell us, it's not just an East Asia story anymore. It's going Southeast Asia as well, for example. Yeah.
Like you pointed out, right? We see, in North Asia, Taiwan, Japan, and South Korea being the golden triangle for the global semiconductor industry. But what's also interesting is we're seeing, Malaysia, India, and Thailand, what I call the MIT. Obviously, MIT made in Taiwan is still the biggest thing for now because TSMC manufactures all the leading edge semiconductor chips that NVIDIA, Qualcomm, and everyone are getting from. But given the kind of relocation of the supply chain, the manufacturing supply chain of the tech industry over the last few years, we've seen, for example, many of the U.S. cloud players now manufacturing their AI servers in countries like Malaysia and Thailand. For Chinese companies, they've seen Malaysia and Thailand as a new manufacturing base to kind of, export internationally. India obviously is benefiting from kind of, made in India initiatives. India is still at the very early stages of, establishing manufacturing for electronics. They're still figuring out how to kind of, expand into semiconductors. But we're seeing a lot of these initiatives, a lot of strategic moves being kind of, planned out over, the next few years.
Do you see us any closer over the next 2 years to being less globally dependent on Taiwan, given the capacity we're seeing elsewhere in the region? Because Taiwan is the bottleneck.
Yeah. I think within the next couple of years, at least, maybe the 3 to 4 year period, Taiwan is still the core, the center of all these leading edge technologies. The reason why I'm saying that is if you look at TSMC Arizona, That's obviously still ongoing. If there's no delays in terms of the setup of all these infrastructure, probably will be ready in the next few years' time. But it takes time to ramp up. Production yields and so on. If you look at Japan, Kumamoto, TSMC, they've made a better progress there, closer proximity, but it's still taking time. Establishing a new high-end semiconductor manufacturing cluster takes time, and you have to get your supply chain over. Like TSMC is, talking, and they're all about localizing their supply chain, as in in Taiwan, use Taiwanese and Japanese suppliers. In Japan, leverage the Japanese suppliers. In the U.S., right, the same. But obviously, given the U.S. haven't actually had that much of an ecosystem to start with, it will take a bit of time.
What about when it comes to Chinese tech? I'm wondering, since you say this CHIPS Act in the U.S. could evolve further under a Trump presidency, should I expect that these tech firms in China, are they still going to be able to continue on with their AI development? Is there enough homegrown chips, for example, from SMIC, from Huawei, that can keep this sort of development going?
Yeah, I think what we're seeing in China is China has embarked on the localization of the semiconductor industry. They know they're behind, but they're trying to catch up. But the race is not only on the wafer manufacturing side. It's not just SMIC. What is interesting is we're also seeing a lot of race in advanced packaging. If you look at TSMC, it's no longer just 2 or 3 nanometer. It's the advanced packaging, the CoWoS. China's also trying to do that. It's not just about the logic chips. It's also about high bandwidth memory. That's what China's also doing. China is still obviously at the very early stages of ramping up these new technologies. They're trying to catch up. There's still some gaps, but the Chinese will continue to kind of focus on localizing their supply chain as the industry decouples.
In which part do you think specifically along the supply chain or along a product segment that do you think China is able to achieve independence?
We're trying to China's trying to be more independent on every segment. But certain areas like lithography, that's a bit challenging. The rest, for example, like advanced packaging, it's really not that advanced. Packaging is really a more kind of commodity, mass market kind of thing. I think China can do quite, make some achievements there. But they will have some challenges on the wafer front. Which can be obviously, hopefully, compensated by advanced packaging. So that's one area.
I know you're into thematic investing. I'm wondering if for investors that are looking at this space in Asia and maybe want to focus a little bit more on this part of the world, what's the right strategy moving forward? I mean, is it still the data centers that we have to focus on? Or do you look at things like network equipment? Or do I look at applications, for exple, of AI? That could be the next stage of this whole AI rally.
Yeah, I mean, this AI infrastructure boom is broadening out. Maybe, at the moment, everyone's focusing on data center. But if you look at the actions in networking, the bottleneck in terms of connecting all these, tens of thousands, hundreds of thousands of AI GPUs, the bottleneck is really on networking. If you look at networking, related companies, they're seeing strong earnings momentum. And it's really because of the speed upgrade, the more, nodes to connect. And you also know about the, data centers now have constraints, physical constraints, power, electricity, thermal cooling. What they have to do now is to distribute the different data centers and connect them with networking. So that's an area. And the broadening out is also benefiting a lot of small mid-cap companies that may not already have a data center infrastructure business, but they have certain technologies that are now being required in data centers. Data center upgrades or the modernization of data centers are now kind of ramping up very quickly. Think about the data centers that we already have near the cities and so on. And the new ones that we're building, it is massive. So the opportunities is way beyond just data centers at the moment.
Yeah, I guess to paraphrase, everyone's looking for the next NVIDIA. I know you can't talk specific stocks, but some of these small caps that you mentioned that do these technologies that will be valuable, in which markets do you think we can find these types of stocks?
Yeah, obviously, I think the innovation that we're seeing. A lot of these actions are in the Golden Triangle, like Taiwan, Japan, South Korea. But I also would say, outside of the U.S., where these U.S. Tech giants are increasingly relying on manufacturing, as I mentioned, Malaysia, India, Thailand, smaller companies, low end, but now they're upgrading. So a lot of opportunities there. Europeans also have quite interesting technologies as well, something to also focus on.
Okay, YT, thank you. It's great to have you. YT Boon there, thematic Asia head at Neuberger Berman. We got plenty more ahead. This is Bloomberg. Here are some of the major corporate stories we're following for you today. Airbnb's third quarter bookings and adjusted earnings have beat estimates. The company says it is particularly encouraged by the recovery of the outbound China business. Airbnb gave a strong outlook, seeing an acceleration in key metrics, with the growth rate likely to exceed the 8.5% achieved in the third quarter. ANZ's full-year profit missed estimates, and CEO Shane Elliott says competition in the mortgage market remains intense. Cash profits slipped to $4.5 billion from nearly $5 billion the previous year. Australia's biggest banks face further challenges, with rates potentially poised to fall next year.
Let's check FX markets in the G10 space. So we have the Aussie dollar. We talked about ANZ. Rate decision, of course, overnight, in case you missed it. Apart from the Fed was the Bank of England. More on that in a moment. It's really been about weakness in the euro that's at least shown up across most of the crosses, and the dollar index. In fact, I think the dollar index, ICE, is actually poised for, I think, the 7th week of gains in the last 8. Something along those. It's been a period of dollar strength, effectively. The pair on the euro pound is actually quite near the lowest going back about 2 years. So a little bit more on that, and it takes us back to 2022 levels. And a lot of that, of course, might have to do with all the central bank commentary coming through.
Yeah, and just earlier this week, we were talking about this volatility in the gilts market, just given the fiscal loosening that we've been seeing with this budget and all the like here. And we got a little bit more kind of context here from the Bank of England Governor Andrew Bailey, saying he did discuss potential market reaction with the Chancellor Rachel Reeves before and after the budget announcement that really rattled investors there. So he spoke to Bloomberg after that BOE cut by a quarter point to 4.75%.
There are a lot of uncertainties out there, both in the world and there's domestic uncertainties as well. So we've emphasised the word gradual again, because we're going to have to take account of how those uncertainties play through. I'm not really in a position, I'm not going to, any of us are in a position to say, well, gradual means every so often. That is not a judgment that we make.
But it's a judgment that the markets are making. So if you take away any major shocks, does it seem right?
Well, I think the markets have made that judgment. I think it's a reasonable reflection of the forecast that we've published today, by the way, but which is, by the way, conditioned on the market curve. So it's a reasonable sort of reflection of that judgment that we think inflation is going to come back to target sustainably within the sort of horizon that we look at.
Governor, the Chancellor said she spoke to you at the IMF, also about the budget and some of the things that were coming up. Did you warn her of market volatility or what the market would do?
Well, we talked at the IMF about, I think the Chancellor said, we talked about the IMF about her evolving thinking about the budget and her evolving thinking about the fiscal rules. We have, I mean, by the way, we have a very regular dialogue. I'm on my 6th Chancellor since I was appointed, 5th since I started, and with all of them, we have a very regular dialogue. So Chancellor and I do that. So we talked in Washington about her evolving thinking about the budget, about the fiscal rules, and I think the Chancellor said, we talked last week about markets. She asked me for my assessment of markets. As the Bank of England is, we provide the Treasury with our assessment because it's obviously something that we're very close to. I'm very, very open and willing to provide that assessment. So yes, we talked through the assessment of markets.
So, but this was before the event. So was the market reaction expected on your side?
Well, both before and during, actually. So look, I think that if you go back to the beginning of last week, our assessment of sterling rates markets was that at the shorter end they were sort of positioned long for interest rates to go down. further than was expected. I think that obviously changed during the week. It wasn't surprising to me, therefore, that there was a closing out of positions, and probably stop orders were being hit. That closing out needed to take place. I think it took place in an orderly fashion. We weren't seeing disorder in the markets. And by the way, I think by Friday afternoon post non-farm payrolls, the dominating event in markets was expectation of the US election, not the UK budget.
Do you think the Chancellor was expecting markets to behave that way?
Well, I think this was obviously a big budget, as the Chancellor herself said. So I think it's reasonable to expect that markets will respond to it. I mean, they knew some of things. They didn't know, they didn't know the precise form of it until it was delivered by the Chancellor in Parliament. So I think it was entirely appropriate to have some reaction in markets. But the point is, it's been an orderly reaction. That's markets move. We should expect markets to move. It's only when they become disorderly that we should be concerned in that sense.
Governor, I know you're very reluctant to talk, what possible trade wars or tariffs from the U.S. would look like on the economy, but would they be inflationary or would they reduce growth?
Well, I mean, we don't know the answer to that question. I think, what I will say is, look, the UK is a very open economy. So obviously this area matters. The Chancellor has said yesterday and today, quite rightly, and I will join her in this, that she will make the case for open markets and free trade. And I will strongly support her in this because I'm a very strong supporter of free trade. I think you would expect the UK to do that. We have a very proud history of free trade in this country. We will no doubt, say our piece and make our case. But we'll see. I think it's important just to say, look, let the new US administration get into office. We will work with them. I've worked with a lot of US administrators over my career. We will work with the next US administration just as we do with the current one, and we did with the previous Trump administration, by the way. I expect constructive relations, and we will have a good dialogue.
And that was a Bank of England Governor Andrew Bailey speaking with our colleague Francine Lacroix, of course, on the back of that rate decision which came through yesterday. If you are a Bloomberg subscriber, you can catch up on all the interviews you might have missed. Our interactive TV function, TV Go. Join the conversation by sending us instant messages to our team and our guests during a live show. Check it out on TV Go. Plenty more ahead. There's a special segment just ahead. You will not want to miss what is forthcoming. This is the China Show. All right, welcome back. You're watching the China Show. We're looking at, a couple of sectors to track here. When you look at the Hang Seng Index intraday, let's have a look at that first before we get to some of these big movers that we're tracking to the downside as we, I guess, look ahead. The Hang Seng Index has now reversed completely all of its gains. We're now trading flat there. Yeah, going into the last, hour of the session here. Some of the sectors we're tracking here, some of these baby-related stocks. Let's get it up, please. So you have Feihe, you have Mengniu, A2 Milk, I believe, is their pigeon, which makes, of course, baby-related products. I think, and also there's this note out of Bloomberg Intelligence talking about 11/11 is coming up. It's a special shopping season, and they do expect some of these discounts around milk products. Out and about. So, I mean, I guess people could take advantage of that. And if you think that's random, this next shot's about to tell you.
I'm going to need those discounts, Dave.
She will. There we go. Hello.
No. You wonder, we launched this show with both of us standing.
Like this, yeah.
And then I think a couple months in, I said, nah, we can't stand anymore.
We need to change the blocking, which is probably... Yeah, but
if you haven't noticed, it's the worst kept secret ever. But yes, no, I thank you so much. I'm going to go on maternity leave next week, so I just wanted to say thank you for everyone. I'm glad that I'm leaving the show in good hands. And we've built the China Show for a few months now, and we also got a nomination, right? So fingers crossed, we're doing quite well. But I'll see you guys all next year, guys.
Yeah, so we're attending. Well, let's hope we win, number one.
It's actually the day after my due date, so we'll see. And fingers crossed.
We're not going to give too much detail in case we don't win, which is fine. by the way. Just don't look it up. But yeah, I mean, we'll keep the seat warm. And
thank you.
In the, I think it's quite fitting that we're actually ending Yvonne's last day before she goes in mat leave in the same position. This year was really about us starting this baby of a new show, which is the China show. And
it was one of many babies that I'm going to have.
That's right. And we're wrapping up the NPC Standing Committee meeting today, and you'll see Yvonne back after the NPC in March or April.
Well, I said I wanted to get through the U.S. election, and I wanted to get through at least the last day of NPC.
Yeah.
That's it for us here in the China Show.
Time for
Insight
drinks.
with Yvonne Man is next. See you guys later.